Welcome to Wealthfinity. In this channel, we dive into the exciting world of stocks and the financial markets. Investing in stocks can be a great way to build wealth, but it's important to understand the tax implications of your investments. That's why we're here to give you a comprehensive guide on everything you need to know about stocks and capital gains tax. Join us as we explore the ins and outs of investing in the stock market, and how to navigate the tax code to maximize your gains. Get ready to elevate your financial literacy and achieve wealthfinity. As an investor, you want to make the most of your investments, and this includes understanding how taxes will impact your returns. One of the most significant taxes you'll face as a stock investor is the capital gains tax. Stocks and capital gains tax are important concepts for anyone looking to invest in the stock market. In this video, we will provide a comprehensive overview of what stocks are, how capital gains tax works, and what you need to know to make informed investment decisions. Overview of capital gains taxes and how they apply to stock investments. What is capital gains tax? Capital gains tax is a tax on the profit you make from selling an asset, such as a stock. It's the difference between the price you bought the asset for and the price you sold it for. If the price you sold it for is higher, you have a capital gain, and if the price you sold it for is lower, you have a capital loss. Capital gains tax rates vary depending on how long you held the asset and your tax bracket. If you held the asset for less than a year, the capital gains tax rate is equal to your marginal tax rate. If you held the asset for more than a year, the capital gains tax rate is generally lower. How does capital gains tax apply to stock investments? When you sell stocks, you will be subject to capital gains tax on the profits you made from the sale. The amount of tax you'll owe will depend on how long you held the stock in your tax bracket. If you held the stock for less than a year, the capital gains tax rate will be equal to your marginal tax rate. This rate can be as high as 37% for the highest tax bracket. If you held the stock for more than a year, the capital gains tax rate is generally lower. The long-term capital gains tax rate ranges from 0% to 20%, depending on your tax bracket. It's important to keep accurate records of your stock purchases and sales to determine the amount of capital gains tax you'll owe. You'll also need to report the sale on your tax return and pay the capital gains tax owed. How can you minimize capital gains tax on stock investments? There are several strategies you can use to minimize your capital gains tax on stock investments, including: hold on to stocks for longer periods. By holding on to stocks for longer than a year, you'll be eligible for the lower long-term capital gains tax rate. Harvest losses. If you have stocks that have decreased in value, you can sell them to offset any capital gains you have. This strategy is known as tax loss harvesting. Use a tax-advantaged account. Consider investing in a tax-advantaged account, such as an individual retirement account, IRA, or a Roth IRA, where capital gains taxes are not owed on investments held within the account. Capital gains tax is an important consideration for stock investors. Understanding how it works and how to minimize it can help you maximize your investment returns. As with any tax matter, it's always best to consult with a tax professional for personalized advice. By following these basic principles and working with a financial advisor, you can ensure that you're making the most of your stock investments. What are stocks? Stocks, also known as equities, represent a share of ownership in a publicly traded company. When you buy a stock, you become a part owner of the company and have the right to receive a portion of the company's profits through dividends. Additionally, stocks have the potential to increase in value over time, providing investors with capital gains. Capital gains tax. Capital gains tax is a tax on the profit you make from selling a capital asset, such as stocks, for more than its purchase price. Capital gains can be short-term or long-term, depending on how long you hold the asset before selling it. Short-term capital gains, which are gains on assets held for 1 year or less, are taxed as ordinary income at your marginal tax rate. Long-term capital gains, which are gains on assets held for more than 1 year, are taxed at a lower rate, ranging from 0% to 20%, depending on your income. It's important to note that not all capital gains are taxed equally. For example, if you sell a stock for a profit and reinvest the proceeds in another stock, you can defer paying capital gains tax until you sell the new stock. This is known as a tax-deferred exchange and can help you reduce your overall tax bill. What you need to know. When investing in stocks, it's important to have a clear understanding of how capital gains tax works and how it will affect your investment strategy. Here are a few key points to keep in mind. Capital gains tax rates are subject to change. It's important to stay informed about any changes to capital gains tax laws and how they may impact your investment strategy. Consider the tax implications of your investment decisions. For example, selling a stock for a profit will trigger a capital gains tax liability, so it's important to factor that into your decision-making process. Keep accurate records of your stock purchases and sales. This will make it easier to calculate your capital gains when it's time to file your taxes. Work with a financial advisor or tax professional to develop an investment strategy that takes capital gains tax into account. Stocks and capital gains tax are important considerations for anyone looking to invest in the stock market. By understanding these concepts and taking a strategic approach to your investments, you can maximize your returns and minimize your tax liability. In conclusion, understanding stocks and capital gains tax is crucial for any investor or trader. It is important to know the basics of stocks, including what they are, how to purchase them, and how to monitor their performance. Furthermore, it's equally important to have a clear understanding of capital gains tax, including the types of capital gains, the tax rate, and how to calculate and report capital gains on your tax returns. By having this information, investors and traders can make informed decisions and plan accordingly to minimize their tax liability.